3 ways to access cash: sad, dumb, and smart. In this episode, I'm going to address the question, how do you withdraw cash from a life insurance policy? Put on your seatbelt. You're going to learn some things that you probably didn't even know existed before about how to accumulate, access, and transfer your money totally tax-free. So my name's Doug Andrew. I've been a financial strategist and retirement planning specialist for more than 46 years, and I've authored 11 books. I have a national radio show. I helped so many of my clients, thousands of clients across the country. And then from 2003 to 2007, I trained over 3,000 CPAs, tax attorneys, and financial advisors. In 2005, I let all of my professional licenses automatically just expire to become a consumer advocate, to write books and to empower and educate people like you. This is what I love to do. I'm 68 years old and I want to continue to educate and enlighten people with opportunities that maybe they didn't know existed before. So when people ask that question, how do you withdraw cash from a life insurance policy? I usually say, well, there's the sad way, the dumb way, and the smart way. And they go, what are you talking about? Okay. In a nutshell, the sad way is by dying. Now, to be honest with you, it's one heck of a return, but I don't recommend it, okay? But if I put in $10,000 into a $1 million or $2 million life insurance policy, and I die the next day, you know, I sometimes tease my wife. She doesn't like me to do this. You know, if I go out riding four-wheelers or hunting or whatever, and she goes, be careful. Last time you were fishing, you almost fell off that cliff or whatever on that lake. And I go, honey, you know, if I go to Alaska fishing, she'll always worry. And I say, honey, listen, will you do me a favor? If I get eaten by a grizzly bear, would you promise to try to look down and look sad at my funeral? Because you're going to be loaded with tax-free cash. And she goes, oh, you're more valuable than all the millions of dollars and so forth. But see, it's the sad way to access money. But if I put in 10 grand and I die the next day or the next month or the next year, and I leave behind 2 million, 3 million, 5 million, whatever the death benefit was, that's totally tax-free. That's calculate the rate of return. It's incredible. But I don't recommend it. But that's a nice benefit. Now, most of the life insurance policies that I've helped people with, they came to me not necessarily wanting or needing life insurance death benefit. They were okay with it. People don't object to death benefits. They object to paying for them. The way I would structure the indexed universal life insurance policies for my clients, it was designed to allow them to accumulate their money totally tax-free, be able to access that money tax-free when they retire, so that every $1 million can generate, you know, $60, $70, $80, $100,000 a year of tax-free income without depleting principal. Nothing else does that. IRAs and 401ks cannot generate that. You cannot predictably have that kind of income if your money's in the market, and then you have to pay tax on it and everything else. So this has been the dream solution for many people's retirement, but other financial goals. You maximum fund the insurance policy, take the least amount of death benefit the IRS will let you get away with, and then it turns into this cash cow. So when we talk about withdrawing cash, if you're going to do it for living benefits, my heavens, you want to use the smart way, because the dumb way would be to withdraw your money. Here's why. So what's the dumb way? Well, when you have cash value inside of an insurance policy and you need to access it for whatever reason, you can withdraw your money. It's called a partial surrender oftentimes. And so there's a problem when you withdraw your money. I mean, it's your money, you withdraw it, but then that restricts how much you can reinvest or put back. And so I don't like to withdraw it because it limits, it reduces down a grandfathered room I had to invest on a tax-free basis. Life insurance cash values are taxable FIFO, whereas most investments are taxed LIFO. LIFO means last in, first out. So if you put, let's say $500,000 into an annuity is a savings account with an insurance company in its simplest form. And you put in 500,000, let's say you were earning 10%, which most of them are not, but it's simple math. 500,000 at 10%, you could pull out 50,000 a year, right? Well, the IRS says that is the last money you're earning is your interest. You're pulling out the 50,000. Only if you start accessing some of your basis, the original amount you put in there, do you get a tax break on that. So the last money you're earning is the first money out. Most investments are taxed LIFO. Insurance is one of the few in the Internal Revenue Code that's taxed FIFO, first in, first out. So if I put $500,000 into an insurance policy, I was earning 10%, which I have many, many years. 50,000 a year, because I had many clients do this back in the 1980s. They put in $500,000 and they started taking 50,000 a year of tax-free income. See, the first 10 years, you're just simply recovering your 500,000, 50,000 a year times 10. The first money in is the first money out. You've already paid tax on that, so it's tax-free. But see, that would be dumb because you now have to start paying tax in the 11th year in that example. So now you keep pulling out 50,000 and now you're into your gain or your interest. That's dumb. The IRS actually says you don't need to do that. Just change the nomenclature, change what you call it, and we will not tax you. This is not a loophole. Don't call it a surrender or a withdrawal, call it a loan. And people go, what? Borrow my own money? Why would I borrow my own money? Watch, the smart people do this. So when clients come to me and they need money for a business venture or an emergency or to help their kids with college funding or retirement, they know the procedure. It's a one-page form from the insurance company. So they put their name at the top and their policy number, which is like an account number. And then it says, would you like to withdraw $1 million? Okay, if they have $1 million or $2 million, it doesn't matter whether you have half a million or 10 million. But I have a client who's a business owner and he usually pulls out money to have earnest money on a huge apartment complex he wants to buy. And so he says, Doug, send me one of those forms. Well, he knows what to do. And when it says, do you want to withdraw $1 million? Or check this box, do you want to borrow $1 million? Which one do you think he checks? Oh, borrow. See, if he withdraws it, he can't put the $1 million back with the same guidelines that he could have put it in the first place. So he's permanently reducing the ability to have money grow tax-free. But then if he takes out more than his basis, then he has to pay unnecessary tax. So he borrows and he has two choices. Okay? Do I check this box? A zero wash loan. Well, if the economy is struggling and everything like that, he may do the zero cost loan. So he may say, well, I want to borrow $1 million. Now, in order to call it a true loan, the insurance company has to charge a nominal interest rate. So that might be 2%. And so they charge him 2% on the $1 million, that's $20,000, but he doesn't have to write out a check. He doesn't have to pay that out of his pocket. So on a $1 million loan, if he chooses what is called a zero wash or zero cost loan, at 2%, the insurance company is going to charge him $20,000 of interest that year on the $1 million. Now, he doesn't have to write out a check. How is that covered? Well, the insurance company collateralize that loan with his cash value, and they will credit him the exact interest rate they're charging him. So he's earning 2% on the money that he did not withdraw. It's still sitting there. The insurance company simply used his cash value as collateral. In other words, his money was not touched. It's still growing. The insurance company loaned him the equivalent of the cash, or the interest that he's paying on that is credited. So he earns $20,000. That covers the $20,000. It's a zero cost. Why would you do that? Because loan proceeds are not deemed earned, passive, or portfolio income. They're totally tax-free. And this has been established in the Internal Revenue Code forever. So it makes the $1 million totally tax-free. Well, he has another option. He usually chooses this one. He says, you know what? I'll pay a little bit higher interest rate. You can charge me 4.5% or 5%. And this is called an index loan or a participating loan. So on $1 million, you charge me 5%. That's $50,000. Why would you do that when he could get away with just $20,000? Because the insurance company will credit him the indexed rate on the full million that he left in there, okay, earning interest. There have been years where he borrowed at 5% and he earned 16. He earned 25% in 2017. Did you understand what I just said? He pulled out $1 million. They charged him $50,000 on his ledger, but they credited him on the same ledger $250,000 on that same $1 million. He was earning a net of $200,000 tax-free on his money while he was using the money for something else. This is incredible. This is why people, when they retire, if they simply borrow, let's say out of $1 million of cash value in their insurance policy, if they borrow, let's say $80,000 or $100,000 a year, they borrow at 5 and they keep earning just 7. That will tweak their cash flow by 2 percentage points. If the insurance company is only able to credit 8% at a given year, he can still probably pull out $100,000, even though they're only crediting $80,000 because of this arbitrage or spread by taking out money the smart way, by continuing to earn higher interest than the insurance company is charging. The loan is never due and payable during your lifetime. Did you hear that? It's washed away when you die. You can pay it off if you have new money, and sometimes that's smart. If you have new money, you just reinvest. The insurance company says, oh, they're just reinvesting. The IRS says, oh, they're just repaying a loan that they technically didn't have to pay, but they're doing it. And that means people with new money down the road can throw money back into a grandfathered insurance contract and hit the ground running because they've already complied with all the IRS guidelines to have their money be tax-free. So if you've gotten a few epiphanies or insights or ahas, you have no idea what you still maybe don't know. And that's why I've written 11 books and that primarily focus on how to optimize your financial assets. My most recent, book number 11, is called The Laser Fund. See, LASER is an acronym that stands for Liquid Asset Safely Earning Returns. And in this book, you'll learn how to diversify and create the foundation for a tax-free retirement. It's 300 pages. It's actually 2 books in one. One is 14 chapters with all kinds of charts and graphs and explanations. But if you learn more from stories, you flip it over and you read this side. This is 12 chapters and 62 actual client stories. I'll tell you what, I'll buy the book. It retails for $20, but if you go to laserfund.com, claim your free copy, and you do that by simply paying $5.95 shipping and handling, which frankly doesn't quite cover the shipping and handling, but I'm more passionate at this stage in my life, I'm 68, to educate people. So let me fire out a free copy of this book to you, and you'll learn more about how to optimize your assets and minimize taxes and empower your retirement to have double, triple, maybe quadruple the net spendable retirement income. And then if that intrigues you, you can watch other episodes on this channel and learn about how to accumulate, access, and transfer your money totally tax-free.